I am a lawyer. I am not a supervisor. I am not an academic. I am a practicing lawyer. And I must make a disclaimer from the beginning. I am the secretary of the Spanish Crowdlending Association. Most of my clients are fintech firms. So you may find that I have a certain bias in my views. I do. I will tell you from the beginning what my conclusion is. The butler did it. It was he who killed the people. No, he didn't. My view is that the problem fintech firms have, is in a slight degree a regulatory problem. It is in a very large degree a supervisory problem. And I will be speaking about that. I will give you my views on a possible solution to this supervisory firm. First of all, and I think PSD2 gives us the perfect example of why things do not work as well as they could and how they could be fixed. This is the conclusion from the Basel Committee put out a consultation paper on fintech and its impact on banks. As you see, the largest part of fintech is in the payment services. Why? Because payment services lend themselves very easily to be technified. Actually, there's no way to do them other than using technology. So, and within the payment services, you see there's payment, settlement, and clearing coming together. The biggest part of these portion goes to payment services. So it's mostly payments that will be the future of fintech for banks. What does PSD2 do? And forgive me if I am boring. PSD2 does two things. First, it creates two new categories of payment services providers that need to be authorized. They are already operating, but they do not need a license, and therefore they haven't gone to the trouble of getting one. These two types of this new category of licensed entities includes two entities. First is the account information provider, the people who will give you information on the state of your accounts in different banks, and I will use an example. The second category is the initiation services providers. Why do you need an ISP, an initiation? Because not everybody has a credit card or a debit card. So if you are buying clothes or books in Amazon, you need to let Amazon know how you're going to pay them. If you don't have a credit card, e-commerce becomes very complicated. So what you will use is one of these ISPs. The ISP will inform the e-merchant that you have already ordered the bank to pay. And the merchant can then deliver, can then send you the merchandise that you have acquired. In order to provide these services, both the ASPs and the ECPs need to access your bank account. So the second very important thing that the Payment Services Directive does is force banks to open the vault of data. Banks are required to allow these payment services providers to access your account. So everybody can see the data in your account. As you can imagine, banks have been less than enthusiastic about the idea of providing information that will facilitate their competitors to compete. And there has been a long discussion on the RTSs to implement the directive. The RTSs, the Commission finally approved and issued the RTSs this past November 27. There is a small victory in banks in the RTSs in that screen scraping, the practice known as screen scraping, has not been allowed. Screen scraping means that you as an e-consumer will give the services provider your code name, username, and password to access your bank account. So the services provider will access your bank account using your identity. And the bank has no way of knowing whether this incoming visitor to your bank account is yourself or is somebody else. Banks resisted the practice of screen scraping, saying that it created significant security risks. So banks are being forced under the directive and the RTSs to establish what is known as APIs, which is Application Programming Interfaces, interfaces that will allow, an interface is code really, and it will allow the service provider to connect to your bank account using this safe interface that has been designed by the bank. This obviously creates significant challenges for the banks. The banks are the ones who are doing the tough work, safe customer identification procedures. The bank is the one who is doing the crucial work of the key knowing your client. The bank is the one that has to do all the verifications for AML purposes. And the service provider will be able to rely on that customer authentication that has been made by the bank and the identification that has been made. There are significant rules in the RTSs on what does safe customer authentication mean and how you do that. So the banks are faced with competitors that are challenging their model. The real business of banking nowadays, this is not really deposit taking any longer. The banks are really becoming data owners, massive amounts of data owners and exploiters of this data. So how can the banks live up to the challenge? The first, if you can beat them, join them. N26 is, to my view, the perfect example of what a real fintech bank is. As Peter was saying, being a fintech bank doesn't mean that you have an old back office with legacy servers and you have a great customer interface application. This is not what it is about. What it is about is really being N26. N26, they are not a client, first of all, so I am free to talk about them. N26 only operates in your phone. There's no other way. You can use the services of N26. N26 is a deposit-taking bank. It is regulated by the German authority. They will receive your deposits and they will provide you the whole gamut of financial services just on the phone. There's no other way you can use them. As you can imagine, for youngsters or people younger than we are, there are some, who live literally in the phone, they won't dream of visiting a brick and mortar phone. I mean, going to an office, going to a bank branch to discuss something or talk to people? I mean, well, which planet do you come from? They will use the phone. And banks like this one will allow them to do everything on the phone. The banks and BBVA in Spain would be another example. BBVA defines itself as a fintech bank, and they see no reason why they are not treated as a fintech or even a startup firm. And they see themselves as librarians of data. Really, Amazon knows a lot about you, but your bank does also know a lot about you. And they see themselves as being the owners of this data, the exploiters of this data, and the users of this data. If the bank knows where you live, the bank knows your mortgage, the bank knows how much you're being paid per month, the bank knows how much you're spending per month, which types of expenditures you're having. The bank is situated to offer you, maybe you want a loan to send your children to do a master's degree in the US. Have you thought about that? So this is how they see themselves. They have an additional advantage. The bank is in a great position to become the provider of your digital identity. An ongoing problem and an increasing problem, we all have digital identities. But digital identities are very bothersome. Every time you try to open an account in a merchant, in a bank, a financial services provider, if you want to buy insurance, every time you try to buy something in the internet, which is the biggest mall really there is, you have to go through the hassle of proving your identity. Every time you have to type and you make mistakes and you have to go back, and then the page tells you that you have failed to fill this or this other field. The banks are in an ideal situation to give you a digital ID that you could then use everywhere. Some countries have established systems that will allow people to do that. Sweden has a specific system of financial digital identity whereby once you have been identified, once you have been authenticated as a customer by one bank, this authentication can be used in any other situations. Other countries, such as mine, will not allow you to do that. Our financial investigation unit insists that there are identifications, repeated identifications every time you do that. And this brings me to my following point. Both Peter and the gentleman in the back have raised the question. In practice, as a practitioner and as a citizen, I find myself confronted to a problem, which is the following. I see myself as a human being, just one human being. Whatever I am doing, I am one human being. But regulators and supervisors will see me as a segment of human beings. So one segment of myself will be regulated for data protection purposes. Another segment of myself will be regulated for banking, financial services purposes. A third segment will be regulated for consumer protection. Regulation I could live with. It's supervision that is a hassle. Each of these segments will be supervised by a different supervisor. Peter was mentioning that he is co-chair of the group, of the FISMA group on innovation, together with somebody from the data side. But Peter is a regulator. He's not a supervisor. So I will find myself confronted to different supervisors for what is, in my view, exactly the same activity. And in the view of my service provider, it is also exactly the same activity. So my service provider will be subject to the Data Protection Authority, and it will be subject to the Financial Banking Authority, which it's not only that they do not talk to each other, it's that they couldn't care less about each other. And this makes innovation very difficult. And I am interested in innovation because I am a consumer and I want my service provider to provide me with as smooth a service as possible and as safe a service as possible. And this again brings me to my following point, which is that PSD2 is again a perfect example. It's not only the incumbent banks that are being challenged and have to adapt, it's the supervisors also who have to adapt. You remember the ATMs. There is an extremely interesting, and to many of you probably prehistoric commission communication dated 1997 on what is exactly an establishment. This was a decision that was adopted under the second banking directive. And at the time, we were trying to discern what freedom of establishment mean, what the freedom to provide services meant, and the question was, is an ATM a branch? If a French bank establishes ATMs in Spain for French tourists to be able to draw money and hopefully spend it in Barcelona, is that a branch? Because if it is a branch, the French bank has completely ignored the regulations. But if it isn't a bank, if it isn't a branch, and the French bank is providing services as it can, then it's okay. This was really, to my view, the first time the European regulator was confronted by technology and technological problems. The decision in this case was an ATM is not a branch, it is a machine. And machines, by definition, are not branches. Branches have to be run by people to fit and proper, etc. But a machine is not a bank. So we will treat this as a pure problem of free provision of services. And that was a good example of the first challenges that supervisors found. In the old days, regulations are conceived as if there were always human beings doing things, you know? A human being sitting in a branch that will receive the customer and will provide services to the person. A human being deciding what is the best portfolio allocation for someone who wants to receive advice or portfolio management services. A human being who is moving money from one place to another. Technology does not need human beings. You will need someone at some point to define the algorithm. You will need someone to create the application programming interface. But once you have that, human beings are really better left to do other more enjoyable things. You do not need them. But yet the regulations and the supervision is conceived as if human beings were still there. That's the first challenge. The second challenge is that technology allows you to access amounts, massive amounts of people, hordes of people. In the old days, if you wanted to build a customer base, you would need commercial representatives, you would need agents, you would do mailings, you would invite people to hotels to present, etc. Technology allows you to reach these masses of people without even meeting them physically. And that creates big challenges for supervision. And I think supervisors are not yet attuned to those challenges. I have drawn what is, to my view, the continuum of the challenge. And I have used crowd lending, I have used the lending club, which is a big crowd lending platform. Why? Because, and in this, it's the only point in which I do not see eye to eye with Peter. It's not true that the European regulations are already there. It's true for, say, robo-advice or robo-management. I mean, the relevant part of, for regulatory purposes, of robo-advice or robo-management is not the robo part, it's the advice or management part. So regardless of how you deliver the service and regardless of the technology you use to create the service, you are still providing a MiFID service and a very clearly defined MiFID service. But this is not true of all fintech developments. It's particularly not true of crowd lending, and I'm infinitely glad to hear that you are putting together a European platform. It's certainly not true of cryptocurrencies. Cryptocurrencies can be regulated as a security or as a commodity or as something else, which means that they are not really regulated, which in turn means that initial coin offerings are subject to what exactly? So it's not true that regulations are entirely there. But let's assume that they are. So if you are a disruptive firm, the first thing that you can do is go the lending club model. Lending club is a crowd lending platform, crowd lending, crowd equity platform. It was operating in the US before the SEC defined the rules. Once the SEC defined the rules, Lending Club discovered that what it was doing was illegal because they needed to be authorized as a platform. So Lending Club stopped offering services in the internet. That was what brought it under the regulation. It completely stopped its internet presence, went into a lengthy and detailed negotiation with the SEC, as a result of which it helped the SEC shape its views on the crowd lending or crowdfunding business. And once that was done, it became authorized with full honors. So this is the good guys, okay? This is the best pupil in the class. The second model, the second business strategy you can use is regulatory avoidance. Regulatory avoidance basically means doing a mimicry of what you want to do, so you will obtain exactly the same economic object, but you won't be subject to regulation. And a good example of that is, Jenny, the use of DTAs. Banks cannot use deferred tax assets as regulatory capital, which is a pity. But you can securitize your deferred tax assets. So essentially, you will take your deferred tax assets. You cannot use them for regulatory capital for a very good reason, which is deferred tax assets can only be used if you become very profitable in the future, which you may or may not. So it makes sense that you cannot use them as regulatory capital, but you can sell them to somebody else. You take your deferred tax asset, which is a credit you have against the tax authority, and you either sell it wholesale or you tranche it, splice and tranche, and you sell it to somebody else. And then what you have in exchange, you can use as regulatory tax capital. Perfectly. You have done exactly, you have achieved exactly the same economic outcome that you wanted to achieve, but you have presented it in a way that is acceptable. This is regulatory avoidance, and we lawyers spend a substantial portion of our time doing that. The next strategy is slightly more aggressive. It's what has been termed regulatory avoidance, which is something between avoidance and evasion. So, say you remember the Alternative Investment Fund Directive. If you are inviting people to put their money together in a project, to share the result of the project, this is an alternative investment fund. No matter what the project is, perhaps it's, say, a cryptocurrency, who knows? This is an alternative investment fund. Alternative investment funds are fine. The problem is that they need a manager, or they need to become themselves self-regulated, which is really a hassle. So what will you do? Well, you will go the old way of club deals. So you will invite people to become part of a club, and the club, from time to time, will do a deal. Are you a fund? Are you a manager? Not really. You are running a club. It's not a systematic form of investment. It's just people who get together and discuss ideas and eventually decide to invest in a project. This, in my view, is really sliding very, very close to the line, but still you are in the gray side. The next one is regulatory evasion, and this is definitely on the red side. So there is something that under your national rules, you cannot do. What will you do? You will go to another jurisdiction where what you are doing is completely legal. And once you are there, you will come back to your jurisdiction to do what you were planning to do. Do you remember the first case that the Court of Justice saw in financial services? That was a case where and I think it was the Belgians actually, the Belgian or the French. The French forbade selling on the phone derivatives to retail investors. So this French firm was established in France, but they were not cold calling French customers. They were cold calling Belgian and Dutch customers, offering derivatives to them. The Dutch authority and the Belgian authority were unhappy about that, but unfortunately, their regulations only captured people who had their head office in Belgium or Netherlands. So they could not regulate these French services providers who were operating under freedom to provide services. So they complained to the French authority, who in turn went to see the firm, who said, I'm not captured by French rules because my head office is in France, but I'm not calling people in France. So nobody really had a jurisdiction over these people. And these people argued that if anybody tried to regulate them, it would go against freedom to provide services. The Court of Justice eventually found that they were wrong and that general interest rules prevailed over the freedom to provide services, and therefore the Belgian and the Dutch could impose the sanctions they were seeking to impose. So this would be a good example of avoidance. But then financial technology presents us with a new way to do that, which is what I have, the Uber model. And I was very interested, Peter, when you mentioned it. The characteristic of the Uber model, and you all remember Uber. Uber started offering taxi services, taxi cab services, in the face of the existing taxi cab regulations. It's not that they were ignorant of these regulations. It was that their business model has been termed by some American authors as regulatory entrepreneurship. We define regulatory entrepreneurship as a business model which is based on forcing a change to the regulations. And technology allows you to do that. When Uber started providing services, it was so obvious that they were flouting regulations that one journalist brought up the question. It was also the case for Airbnb and other services providers. The answer to that was the following. If you identify a law that prevents you from doing something that many people would find useful and you could sell to them, the sensible thing to do is to ignore that law and start providing the service, because eventually the law will be changed, as has been the case, and Uber proves. So why is Uber relevant for fintech services? First of all, because technology transformed the way we buy books, we buy travel, we use hotels, we listen to music. It's completely illusory to think that technology will not have the same impact in the way we receive financial services or we use financial services. And it's only a matter of time in some jurisdictions. In other jurisdictions, such as mine, it has already happened, that somebody decides that the Uber model is a good model to use when providing financial services. Why was Uber able to get away with what it did? First of all, because technology allowed it, and we come back to something we already said, technology allowed it to build a huge user base, which is also a fan base. So by the time a provider of services has over 30,000 users, the problem is no longer a regulatory problem. It has become a political problem, because this user base can be motivated to start demanding changes in regulation, because they like the service they receive and they want to keep receiving it. So this is a first question. The second question is, there was a gray area. Owning taxi cab services requires a license. Providing banking services requires a license. Providing investment services over defined financial instruments requires a license. But there are lots of gray areas, and again, crowdlending comes to mind. I'm just intermediating. There's some people who want money, other people are willing to provide the money, and they just intermediate and they put them together. This is not an alternative investment fund. I'm not managing, I'm not choosing the investments. I'm just putting people together. Well, this is definitely very gray. The difference between a platform, a crowdfunding platform, and an alternative investment manager is not always easy to see to the naked eye. So this is a gray area. Another and very obvious gray area is initial coin offerings. I am offering tokens to people, and these tokens will allow people to receive services that I am planning to create with the money I receive from them. I do not need a prospectus. Why would I need a prospectus? A token is not a security. It doesn't have the characteristics of a security. Or maybe it does, but it's sufficiently gray that I can start doing it, charge ahead, and, well, the supervisor may eventually catch me. But then I will have a huge user base and we can start discussions at another level. Maybe the token I am offering, and this is even more gray, maybe the token I am offering will allow the buyers of the token to receive dividends in the future. And if my company is sold or it is liquidated, it will allow the buyers of the token to participate in the results of the sale or the results of the liquidation. But again, this is not a security. It's a token, a security negotiable a negotiable instrument. Is this a negotiable instrument? Well, it's definitely not a share. It lacks all the characteristics of a share, especially voting right. It's not a non-voting share either, because it lacks the characteristics of a non-voting share. It's definitely not a bond. Is it a derivative? Well, who knows? But it's sufficiently great that I'm confident charging ahead, and we'll see what happens. So the gray areas are fantastic, a fantastic area to be exploited by entrepreneurs, regulatory entrepreneurs, who are interested in building their model and having the model, grow the model, so that supervisors will have a hard time catching up with them. So what is the answer to that? There is, and again, Peter brought that up, there is something quaint about the way supervision is done. And perhaps I am unfair. I speak mostly about my jurisdiction. The provider of services will do something, and then it will report what it has done to the supervisor trimestrally, quarterly, etc. But it's an ex post reporting. And the supervisor has become a bit technologic, so some things can be already sent by an electronic channel, not all things. If I have to file for authorization of an entity, I still have to deposit 100, 200 pages, printed, signed in every page. You feel a bit ridiculous when you are asking for authorization for a fintech firm, and the authorization, and you have to tell your client, here is the pen, here is the stack of papers, start signing, and your client will ask, can't I use my electronic ID and file this in electronic form? And you have to say, no, dead trees, you will still have to print this. So it doesn't make much sense, frankly. And especially, it doesn't make much sense, again, if you look at what PSD2 is forcing banks to do. PSD2 is forcing banks to open the vault so that other services providers can directly come into the bank and see what the bank is doing and access the bank information. Why can account information services providers do that, but the supervisor can't? We had a discussion yesterday, Jenny, about SREP, this new approach, but it's still an approach in which the supervisor does a smell test, basically. Something smells rotten. I don't know very well what it is, so bring me information. Why? If you are allowing services providers to directly inject themselves into the firm, why can't supervisors do that? In my view, it would be a much more effective supervision. It would be a much more cost-effective supervision, and it would make the lives of the supervised entities infinitely easier. Reporting is a hassle, and you have to report, and you have to give information, and then there is another question, and you have to give more information. You need one, in terms of costs, there is someone in the entity whom you are paying to report to the supervisor. For entities, this is very expensive. It's somebody who doesn't contribute to the business, but still you have to have them. When the supervisor could directly have an API and see what you're doing. So this is for existing firms. For firms, again, who are applying for authorization, we come back to sandboxes. The experience, I will give you my experience when you are asking for authorization of a crowd lending platform. the entrepreneur comes to see you as an advisor. You put together the application for authorization on the basis of the model that the entrepreneur is thinking at on day one, and the technology they are planning to use on day one. You submit your application. The supervisor takes 3 to 4 months to understand it and then calls you for more information. By that time, the entrepreneur has changed the model because they have started doing things, they have started trying things, and it turns out that the model is not exactly the same that you had described on day one. So you go back to the supervisor, and the supervisor asks you questions about day one model, and you answer the questions, but say, by the way, I am now using day two model. So the supervisor is unhappy because you're making their life difficult. They ask questions about day two model, you answer them. Another 3-4 months go by which time your entrepreneur is already using day three model. So when the supervisor called you in, they are extremely unhappy and a little angry at you because you are using day three model, and again you keep changing the model constantly. This is a crazy system of supervision. It's crazy for the entity, it's also crazy for the supervisor. It would be so much easier if the entrepreneur were again allowed to start operating in a very limited area. You can start providing services to no more than 10,000 people, 1,000 people, whatever. You can start providing services, but the amount of money you can provide services on is limited to 1 million, 5 million, 8 million euros. And we will be watching you. And we will be watching you really, which means we will not be asking questions that you answer in paper. We will be watching you. And then, after a year, we will decide whether you can start providing services to the general public or not. There are some things that are inescapable, and everybody agrees on that. We will check you for fitness and properness. We want to be sure that you're not El Chapo Guzman, and we want to be sure that you are not some crazy person, that you have the right qualifications to provide the service. But once we have checked that, you are free to start providing the services. Because otherwise, we are inviting Ubers into the system, and we really don't want that as a society. So I'm free. I'm done, and I'm happy to take questions.